Ted, hi, welcome again. How are you doing?
I'm good. How are you, Moeed?
Yeah, pretty good. Pretty good, thank you. I'm actually excited about this particular company we're going to look at because they're all over the adverts in the UK. It's a well-known brand, but I'm also excited because you found something very interesting about the business. So tell me what you found about moonpig.com.
So we're looking at, as you said, at Moonpig, and I thought it'd be first of all we want to look at their financials. So very easy to find Moonpig. So here they are. I picked them straight off Companies House. So publicly available to anybody who wants to have a look. And if we whiz down through the numbers, what we find is so the income statement, here's the income statement. And what I found interesting here was looking at the income statement. So this is the comprehensive income. They're making a profit of about 33 million on turnover of 127 million. Okay, so that's about a 26% net margin. There's the gross profit. So the cost. So effectively, basically, when you buy a card, it costs them half of whatever you pay them to produce the card. And then they've got some admin expenses at the back end, which is the kind of the fulfillment and the postage, etc., etc. So a very simple kind of business model. Effectively, you construct your card online. Drop in your photographs, do your use their template or make your own. And then they send it to you, and you send it off to your aunt or uncle, for example. So quite a profitable business here.
Surprising. I wasn't expecting that actually.
Yeah, well, it's a good business model.
Yeah.
They kind of there's I think there's funkypigeon.com as well, kind of
Yeah.
their rivals. So we might want to kind of compare the two of them. But it's a kind of below the headline amount. So I could pay £10 over here or £8 over there, or I'm going to pay £3.60 or £3.40. And you kind of think, am I that price sensitive? Can I be bothered to set up a new account? And also they're very good at repeat business. So you set up reminders for people's birthdays, and you get the kind of like, oh, do another card, for example.
Yeah.
So and we notice that the headline, some pretty good growth as well. So we're looking at about a 27% increase in the top line sales. So it's all going in the right direction.
Interestingly, the cost of sales isn't going up by that much, so there's some fairly good scalability there.
Yeah, so it's I don't know, it's still about it's about a 10% increase in cost of sales. Yeah, 20%, 10% increase in cost of sales, so, or a little bit more than that. So it's so the cost of sales is in, the margin is holding pretty much constant. They got a gross margin of 57%. It was 52%. They are starting to kind of, they're either squeezing their costs down, or probably more likely they are increasing their prices just a little bit, and it may be product mix, etc., etc.
Okay.
Balance sheet looks pretty healthy. So here's their balance sheet. So the key elements of their balance sheet: non-current assets, things they need to run the business. You can see they've got a little bit of sort of right of use asset. Intangible assets will be, maybe trademarks or licenses. These are the current assets. Surprising, they've got quite a large trade receivables there. Current liabilities. And the non-current liabilities. So they've got a bit of leasing going on here. So they're leasing, I don't know, whatever it is, they're leasing maybe some production facilities or some printing presses, for example. There's their trade receivables. So there's no debt in inverted commas on here. And if we just clear those and move our balance sheet up a bit, we can see the net assets. So, a pretty reasonable a strong balance sheet, and mainly funded through retained earnings. So they're making a profit, and they're putting that profit back into the business.
So pretty healthy.
All looking pretty good. What I found quite interesting about them, though, was is there's no cash flow statement.
Mm.
And the reason there's no cash flow statement is that you don't have to prepare a cash flow statement if you're part of a larger group of companies. So as soon as I don't see a cash flow statement, I usually kind of dig around to find out, you know, are they part of a bigger company? And if we go into the bottom of these guys, and we have to go right to the kind of effectively the very, you know, the very end. So we get to right at the sort of always stuck right in the very bottom. We get things like the contingent liabilities up here, but we also get the ultimate parent group. And so this is quite interesting. So the contingent liabilities, the company is given a guarantee in respect of bank borrowings of Horizon Bidco Limited, and Horizon Bidco Limited is the ultimate undertaking. Okay, so basically
Right.
this company is owned by Horizon Bidco Limited, and this company has put a guarantee on a bank borrowing of 264 million pounds. So we got to go and have a look at Horizon Bidco, I guess, in order to find out what's going on there. Now, Horizon Bidco is a very different kettle of fish altogether. So let me just see if I can pull up Horizon Bidco for you. So this is actually this is Horizon Holdco, which I think is the ultimate holding company. And this company here, you'll notice for the on the profit and loss account, they're making a loss. So their sales are, so just to remind ourselves, the sales of Moonpig are 127 million. These guys are making 340 million. So Moonpig is a small part of this company, which has got lots of other things going on as well.
Right.
And they're trading at a loss. So if Moonpig's making a profit and they're making a loss, then them without Moonpig are making a much bigger loss.
Right.
And if we look at the balance sheet, here's the balance sheet. So once again, the non-current assets, those are the tables and chairs, things we need to run the business. A lot of intangibles in there, which will probably be goodwill. We can have a look at note 9 if we want to. Here are the current assets. Current liabilities, immediately there should be alarm bells going off because the current assets are much lower than the current liabilities. So it suddenly says, are they going to be able to pay? Look at their accounts payable, for example, here, compared with the cash. You know, I mean, they can't even pay their accounts payable based on these numbers. And they've also got lots and lots of debt. Look at this number here. So not only have they got a loan from the bank, but they've also got loans from their shareholders. So this is a company with tons and tons of debt sitting on it. And as a result, it's got a negative balance sheet. Okay. So it's got a negative balance sheet here. And, you know, in effect, what they're doing is they are selling the business, that they're selling their kind of jewel in the crown.
Yeah.
Now, we're not sure exactly why. So this may be some PE financial engineering going on. So you'll notice that the ultimate controlling company here is a private equity company. So sometimes what you find is a private equity company, they load up the business with debt, and that they do that on purpose in order to kind of remove it. Although it looks to me like the actual Moonpig itself doesn't hold any debt. So what we need to do is to have a look at, you know, what they're selling. Are they selling it with debt? So let me give you an example. Here in the UK, we had the AA and Saga. It was bought by a group of venture capitalists. They put them together. They loaded them up with debt, and then they floated them, and they floated them with that debt. So people who bought the AA previously, if you bought it again, you basically bought a company which had so much debt it was almost drowning. You know, and that's the story today. You know, both Saga and the AA have too much debt with them. So this may be some financial engineering going on by the private equity owners.
Just explain to our viewers, Ted, because this is the interesting point. Why would someone do that?
Because effectively, if you it's a leverage play. So effectively, if you can put a pound in to a company, and then you can load it up, you can then borrow the money to buy the company. If you sell it for more, all you've done is you've risked £1, and if you get it wrong, then theoretically you don't lose anything else.
Right.
So sometimes it's a way of getting money out easily, but also it's a way of selling your own debt, because people are buying the future income, and therefore they're kind of, they're not necessarily buying that future, they're not buying the net asset value, if that makes sense. So if you load up a company with lots of debt, you reduce the net asset value, but you don't necessarily reduce the overall value of the business, as long as it can generate that return. And that's where people start to talk about EBITDA multiples, for example, because it conveniently forgets about the interest.
Right. So so when someone invests in the business, and once they floated it, they can theoretically use that money to pay back the debt. Is that what you're saying?
No, they can't. No, they sell the company with the debt.
Right. Okay.
So you take a company, you take the money out of the company and put the debt in, and then you sell it for the same price you bought it. You've just basically taken a whole lot of money out. That's your return.
Right. Okay.
That's the type of thing we're looking at. So if you think about it, it's a bit like if you think about a house, for example. Imagine when you buy a house, you just buy the house, but imagine that houses were sold with the mortgage attached to them. So it wasn't the person who took out the mortgage, it was the house that took out the mortgage. Well, if you look at two houses next to each other, one with a mortgage and one without a mortgage, and they're both rented out, they're both going to be rented out at the same amount. So you're buying the same income stream. The fact that one has a lot of debt and the other one doesn't, well, in that example, you could compare and contrast and say, hold on a sec, I wouldn't do that. But with companies, it's very difficult to compare exactly one company to another.
Okay, fair. Okay.
So here is the prospectus and the income statement. So what we can see here, for example, is that they've got so this number here is the revenue in for the year ended 30th of April 2020. Just to remind you that the Moonpig audited accounts we were looking at was 127 million. So this is going to be other little bits and pieces in there, but it certainly isn't the whole of Horizon. So Horizon was making 340 million turnover. So this is very much, a part of it.
Okay.
And it looks to me like if we look at these numbers, that the gross margin here, that's the gross profit, this number here expressed as a percentage of the sales. The gross margin is pretty consistent, whether you're looking at Moonpig, Horizon, or in this prospectus, or the forecast. You're still looking at about a 50-50. It's about a 50% gross margin. But the bottom line here, so this profitability here, this is 18%, whereas Horizon was at a 30% loss. So effectively, they're taking a lot of this business out, and a lot of that loss will have been driven by interest, for example, and other charges.
Yeah.
So this is affecting, so they're not selling the whole company, but they're selling the kind of the jewel in the crown, so to speak. So this is what you're buying. And what's interesting here is that in 2020 they made a profit of 31 million, and for the first 6 months from April to October 2020 they made another 27 million. So you can start to think, well, that's going to then translate into a total profit of about 55-56 million pounds if they maintain that kind of that growth rate. Okay, and that's quite a significant growth rate. Prospectus, they're looking at sales of 173. If you double this number, you're over 300. So that's quite a significant increase in growth, and that's part of the story of what they're selling.
Right. Yeah.
Can they maintain that growth rate? That's the question. How have they managed to achieve that? Here's their balance sheet. balance sheet's looking reasonably healthy. So once again, we'll just run through the different elements. So non-current assets are the things that we need to run the business. So that'll be effectively the production machinery in here, and some kind of intellectual property rights. So those intangible assets, I would expect, will be there may be a bit of goodwill in there, but a lot of that will be picture rights, for example. So if you think about the pictures that they have on their cards. Here's their current assets. Current assets to the current liabilities doesn't look too healthy. So again, that might start to bring up alarms on a working capital requirement. But actually, these guys, if we run the numbers and we look at these trade payables, it looks to me like their trade payables, they're paying in 120 days.
Right.
So they've got positive cash flow because their inventory is very low. Their accounts payable looks relatively high. I'm not sure why these numbers are so high for a company where, certainly when I order a card, I'm paying, I pay and then I get the card through the post. So that's a little bit of a misnomer to me. But I think they got pretty strong cash flows.
Okay.
So the equity, they've got, they do have, a reasonable amount of equity in there. So pretty strong equity. And you can see here that there's, a lot of share premium and this merger reserve kind of, cancelling it out. We don't have to worry too much about that. But, reasonable amount of equity. There's no debt, so they haven't loaded it with debt and sold it with debt, which is good, which is what happened to the AA, for example. And I think we got some cash flow. Yeah, so the cash flows, again, cash flows looking pretty. So the cash flow is quite interesting. It's difficult to project, but with the cash flow. So this is the cash they're generating from their day-to-day trading activities. That's this number here. So they're generating. So they're basically they got a profit of 30 million, and they're generating 60 million of cash, which is good. And then if we just scroll that cash flow up a little bit, you'll see that they're doing a little bit of investing. That's this number here. So they're investing in plant and machinery. That's absolutely fine. What's interesting down here is the investing activity. So what we notice is that they're making a payment to a group entity. So they are actually, there's a kind of this ongoing payment to other Horizon Group entities, and that's been going on. And it'd be interesting to see, whether they are completely split or whether there is any kind of hangover in terms of their relationship with Horizon, whether they have to carry on making those payments. I would expect it to have been absolutely clear.
That's interesting.
But what it does mean is that for the year, for the 6 months, they've actually lost cash as a result of that. So that's been a big driver, and we need to make sure that that they're clear of that.
Okay.
So let's kind of finish off just looking at the so it's obviously floated on I think it's the 19th of January it floated, so pretty recently. We've got a market cap of 1.4 billion. The net asset value of the business is about 40 million. So it's basically all goodwill.
Wow.
And that kind of makes sense that they're touting themselves as an internet company. They make cards, but it's not, you're not buying the plant and machinery in the manufacturing process. You're buying the kind of the brand, the fact that everybody goes to Moonpig, the kind of the moonpig.com kind of the fact my kids wander around singing it, etc., etc. It's all goodwill. It's interesting they mention a P ratio NA here. The P ratio, I reckon, is anywhere between 25 and 45. So if you take the prospectus as it exists at the moment on 2020 numbers, you're paying 45 times earnings. If you believe that the projection that they're achieving, i.e. the 6 months increase in sales that we saw, you know, if that translates into a bottom line of 56 million, then you're paying 25 times earnings. Now, 45 times earnings is expensive. 25 times earnings is still quite expensive. That means that you've got to, you know, wait 25 years to get your money back. But, you know, the real question is, what's the growth story here? So if the company is embarking on this massive sales increase, is that sustainable? What are their plans? Are they going to take it overseas? Is it going to become, you know, is it a UK phenomenon? Is it going to go, you know, does it go global, etc., etc.? So it's kind of, you know, there's a risk there. Then you start to think about the barriers to entry. How easy is it for other people to compete against them? You know, there's a visibility, there's a knowledge aspect to this, but it's still, you know, it's not that difficult to get into the marketplace. If they price themselves too high, people will leave. So they've got to have a really good product, a really good offering, which they do. It's got to be fresh, it's got to be relevant, it's got to be, you know, it's still quite exciting. You know, you and I, we go out for a meal, for example, you know, with our wives. We take a picture, and then I say to Moe, thank you very much. And what I do is, rather than just sending you a note, I actually do a Moonpig card, and it makes it a little bit special. I've been to an effort to sort of, you know, for that thank you card, you know, and I quite like that. But does it translate into the next generation? Is there sustainability? Is it a passing fad? You know what, I'm not sure. You know, it's a peripheral play if it's in my portfolio.
Yeah. Very interesting, really interesting indeed. So, you know, what are your thoughts, everyone? Do you think this is a business that has staying power? Do you like it? You know, leave your comments in the comment section below. And as usual, like, share, subscribe. And you know, if you want us to look at a particular company that you're really interested in, whether you are interviewing with this company, or if you're planning to sell or do business with the company, or even if you're thinking about investing in the business. If you want us to have a look at the finances and give out opinions and point of view based on the finances, drop us a note in the comment section below, and we'll do a video for you. So until the next video, thank you very much, Ted.
Good to speak to you again, Marie.